Fed officials keep telling the markets to expect rates to remain higher for longer. Our next guest says that this offers the best opportunity in the last 30 years for fixed income investments. Joining us right now is Mel Lagomasino. She is with We Family Offices. She's the CEO there. She also serves on the boards of both Disney and Coca-Cola. And Mel, let's just talk this through, because we had Jim Grant on yesterday, and he said he thinks this is the beginning of a bear market, a long-term bear market for any sort of interest rate investments that you're looking at when they're tied to treasuries. Why do you see things differently? Why is this a great time?
Well, because I think if you think about it from the investor perspective, and you think about people who have a big amount of financial assets, you have a situation where on the one hand, you have all of this great opportunity with the new technologies and the new businesses and the productivity that I think is going to be unleashed with new technologies. On the other hand, which is high risk but high opportunity, on the other hand, these investors haven't been paid for their cash at all for the last X amount of years. Today, they're being paid 5%, et cetera, for treasuries. As we start seeing an end to the hikes in real estate, they're going to be able to lock in 6, 7, 8% for the next X amount of years and anchor their portfolio, so that they actually gives them more opportunity to invest in the higher risk new technologies. So I think if you think about the portfolio for an investor, it's not all about one thing. It's about how do you make sure that you have the cash flow that you need over some period of time. And I think fixed income today, and as you go a little further out, because after Kashkari's comments, frankly, yesterday, I think we need to hold on a little bit in terms of extending duration, because it looks like they might not just be higher for longer. They might be quite a bit higher for longer.
Right. So wait to go long. Wait to go.
But be ready.
What's your duration? What would you do right now? And when you do decide, okay, now it's time, would you do 30 years? Or would you 10?
No, not even.
5?
No, into the intermediates.
You'd go to only intermediate ever. But you'd go out the curve, though. You go to corporates, munis, high yield.
I am still kind of negative on high yield, because I do think that the recession is definitely coming. I think the cost of capital has gone up significantly, and I think at some point we'll see a recession, and I think that will really affect. You
did say to anchor your portfolio, so you're talking about a certain percentage,
liquid,
and then do something with the rest.
But if you think that a recession is coming and rates are still going to be higher and potentially much higher, you think a recession is coming, but inflation is not going to be beaten down, so the Fed won't be able to lower rates.
I think that was Kashkari's comment yesterday, is that, while you have inflation coming down around the manufacturing sector and the product sector, service inflation is going to take longer. And you look at the strikes, the cost of labor is going to go up, the cost of capital is going to go up. So I definitely think that, and I do think the Fed is focused on fighting inflation. So I think we're going to keep rates as long as they have to get inflation down.
And do you think that can work? We're going to talk to Kashkari about that, but that's the other piece of this.
I think that the big boogeyman out there is stagflation, that we get into this period of high inflation and low growth.
It's not good for anything. It's not good for stocks or bonds.
No.
But it's less probably painful.
I think that's
bonds.
A big risk out there, right?
Yeah. Do you, if you do venture into equities, do you like yield stocks? I mean, you seem fixated on getting paid, your money, making some money. Or would you go into the Magnificent Seven and really try to hit a home run?
I think the Magnificent Seven have a place in your portfolio over time on their long-term holds. We don't try to time the market. Obviously, I think that these companies have such a monopolistic hold.
Don't say that. We have Lena Khan coming on later. We're going to play that sound bite, and she's going to go, see. What about yield stocks? You like dividend growers over time? 2% now. They go up 10, 15% a year. No? Boring?
Well, for certain kinds of investors, I think it's good. But I think you can do actually better in the fixed income market without taking the volatility.
Really? Yeah. See, I thought the opposite, that if you can get, well, you're only going 5 years. But in 10 years, if you get 15% dividend increases a year, you start at 2 or 3%, you end up at 7 or 8 with the capital appreciation.
I mean, there's a place for everything.
If the dividends
in your portfolio, the question is, what are you trying to solve for? Yeah. So if you're trying to solve for cash yield, people have had to go out very far on the risk and the liquidity space in the last few years to be able to get that. And today they don't have to do that anymore.
That's an interesting point, just to make sure you have the cash you need without having to cash out stocks. Let's talk very quickly about media. You've been on the board of Disney since 2015, and I know you can't talk about Disney-specific issues, but let's talk about the strikes that we've seen there and the media business overall. Media business is already facing a lot of difficulties because of just the changing ways that consumers consume. They're not going to the movies the same way. They're not watching on television the same way. They like things streamed to them, but that has not managed to find a way to be nearly as profitable. How does this work out, and how do the strikes kind of play into that?
Well, I think the strike almost was predictable. You have a new technology. You have a complete change in the business model. You have a new technology. The minute Netflix came into the picture, basically they disrupted the whole media business. And so I think you have a new technology. You have people obviously worried about and anticipating what's going to happen with this new technology. How is it going to affect the business model? We're all already trying to figure out how do we go and do what the consumer wants us to do, which is to access everything, anytime, anywhere, in any way, and get paid for it. And I think it's kind of normal, if you think about it, that labor is going to say, well, what about me? What happens now? The rules of the game are changing. So I think the business models are going to have to get reinvented.